It's Wednesday, April 1st, 2026, and you're listening to the Commodities Institute podcast. I'm Emily Costa. Today's episode is one of those moments in the commodities world where everything feels interconnected in a way that's impossible to ignore. Energy markets are being reshaped in real time, agriculture is reacting with a lag, but with real consequences. Metals are tightening under pressure, and even long-term themes like renewables are suddenly being tested against geopolitical reality. Let's begin by stepping into the metals space, because it offers one of the clearest illustrations of how quickly supply shocks can ripple through the system. Aluminium prices are climbing again, and not just incrementally. Forecasts have been revised sharply higher after direct disruptions to Gulf smelting capacity. We're talking about major facilities in the United Arab Emirates and Bahrain sustaining damage, removing over 1 million tons of expected production from the global balance this year. That flips what was previously expected to be a surplus into a deficit. Now, aluminium is one of those commodities that sits quietly in the background of modern life. It's in transportation, packaging, construction, and increasingly in energy systems themselves. When supply tightens, the effects don't always show up immediately to consumers, but manufacturers feel it very quickly. And what's particularly important here is the compounding effect. Aluminium production is highly energy intensive, so disruptions to energy supply and infrastructure tend to amplify price moves. So when analysts say the risks are to the upside, what they really mean is that the market doesn't yet fully understand how deep the disruption could go. From metals, let's widen the lens to agriculture, where the story is less about immediate damage and more about shifting incentives. US farmers are already signaling a move away from corn and towards soybeans. That might sound like a routine adjustment, but the underlying driver is anything but ordinary. Fertilizer prices have surged, largely because nitrogen supplies from the Gulf have been disrupted. Corn and wheat are fertilizer-intensive crops. Soybeans are not, at least not to the same degree. So what we're seeing is a cost-driven reshaping of planting decisions. Farmers are looking at tighter margins, higher input costs, and uncertain demand, particularly with lingering trade tensions affecting exports. And they're making pragmatic decisions. Corn acreage is expected to fall by several million acres compared to last year, while soybean planting rises. Wheat acreage, meanwhile, has dropped to the lowest level on record. But here's where it gets interesting. Even as far back, grain stocks remain relatively high. That means prices aren't necessarily spiking yet. Instead, we have this tension building beneath the surface. Strong inventories today, but potential supply constraints tomorrow. It's the kind of setup that traders pay very close attention to because when fundamentals shift from surplus to risk, price movements can be abrupt. Now let's move into energy, where the story is dominating headlines for good reason. Oil markets are experiencing extreme volatility, driven by disruptions in one of the most critical choke points in global trade. The Strait of Hormuz typically carries about 1/5 of the world's oil supply. With shipping constrained, supply has effectively been choked off, and the consequences are immediate. OPEC production has dropped dramatically, by over 7 million barrels per day in a single month. That's not a marginal adjustment. That's a shock on a scale we haven't seen since the early days of the pandemic. Countries like Iraq, Kuwait, and Saudi Arabia have all reduced output, either because they physically cannot export through normal routes or because logistics have become too uncertain. Some producers are rerouting shipments, particularly through the Red Sea, but those alternatives have limits. At the same time, pricing dynamics are becoming more complex. Saudi Arabia is expected to raise its official selling prices for Asia to potentially record levels. And this is where market structure matters. The crude market has moved into what's called backwardation, where prompt supply is significantly more expensive than future deliveries. That signals immediate scarcity. Asian buyers who rely heavily on Middle Eastern crude are facing not just higher prices, but also uncertainty about availability. And uncertainty in commodity markets often carries its own premium. Now, if we step back, this isn't just an oil story, it's a broader energy story. Liquefied natural gas markets are also being reshaped. With Qatar's exports constrained and infrastructure damaged, supply to Asia has tightened sharply. Spot LNG prices have nearly doubled in a matter of weeks. This has created opportunities for producers outside the region, particularly Australia. Higher prices and increased demand could drive investment into new projects. But, and this is crucial, it also raises policy questions. How do governments balance domestic supply needs with export opportunities? How do they ensure energy security without discouraging investment? These are not short-term questions. They will shape the energy landscape for years to come. And yet, in the middle of all this disruption, there's another story unfolding quietly in the background. Renewable energy. Global renewable capacity has surged to nearly half of total electricity capacity. Solar alone has driven the majority of that growth, adding hundreds of gigawatts in a single year. Now, you might expect that a crisis in fossil fuel markets would slow the energy transition, but in some ways, the opposite is happening. Countries with higher renewable capacity are proving more insulated from volatility. They're less exposed to fuel price spikes, less dependent on fragile supply chains. That doesn't mean renewables are replacing fossil fuels overnight, but it does reinforce the argument that diversification isn't just about climate policy, it's about resilience. Finally, let's touch briefly on trade flows and logistics, because even in times of disruption, the machinery of global trade keeps moving. We're seeing continued activity in wheat tenders from countries like Tunisia and Jordan. Prices have edged higher, reflecting broader commodity market strength. At the same time, export data from Europe shows steady flows, particularly in wheat and barley. And in the metal space, cobalt remains tightly controlled, with export quotas in the Democratic Republic of Congo shaping supply. With the country accounting for about 70% of global cobalt production, these policies have significant implications for battery supply chains and, by extension, the energy transition itself. So, when you step back and look at the full picture, what emerges is a system under stress, but also adapting. Energy markets are recalibrating, agriculture is adjusting to cost pressures, metals are responding to supply disruptions, and renewables are gaining ground, not just as a climate solution, but as a hedge against volatility. This is what makes commodities so fascinating. They are, in many ways, the most immediate reflection of the world's underlying dynamics. Geopolitics, economics, technology, they all converge here. And right now, that convergence is happening at an unusually intense pace. That's all for today's episode of the Commodities Institute podcast. I'm Emily Costa. If you found this episode valuable, be sure to subscribe, share, and leave a review.